Howdy, Jacob here. Today we're looking at PLDT, ticker symbol PHI. Sounds a little weird when I say that. It's in the wireless telecommunication service industry. Looks like they provide telecommunications and digital services in the Philippines. $5 billion market cap with an $8.9 billion enterprise value. Doesn't surprise me. This type of industry is pretty debt heavy. On the revenue side, 3.0 billion up to 3.6 billion. Doesn't look like there's a lot of growth, but a little bit of growth is not bad. Dividend payout has been paid out, but the actual payout of dividend has been pretty inconsistent. The dividend per share has been pretty inconsistent. Pretty low returns recently on their return on invested capital. It looks like it's been going down pretty consistently since 2008. Don't like to see that. But we do have an 8.3% dividend yield. So that's definitely a plus for the business if you're looking for excess free cash flow. Looks like 1.8 billion in long-term debt in 2012 up to 3.9 billion in 2022. Over double their long-term debt in a 10-year period. Cash on hand with their short-term investments is under 500 million. So still a grand amount of long-term debt that they don't have the cash for. Let's see what their free cash flow looks like. Okay. So they did not produce positive free cash flow in 2021 and 2019. Obviously, if you look at 2022, it looks pretty great, about 800 million. But if we look at a 5-year average, including the negatives, we're probably looking at maybe $250 million in free cash flow. And so it looks like the capital expenditures have really caught up with them, where their cash from operations is nearly the same, but their capital expenditures is almost double. Their use of free cash flow is just dividends, really. Looks like the tiniest bit in acquisitions. Looks like they've been selling off investments for quite a while, and then been going into a little bit of debt, likely to fund the dividend to be as high as it is. $417 million paid out in dividends, and like I said, maybe a 5-year average of 200 million. Yeah, that's not going to stick for me. So if we cut that 75%, I think that's gonna become about almost a 2.1% dividend yield, which is still above the market, but not the 4% that we're looking at for this screener. Some of the other assumptions, it's a relatively flat business. Maybe I say they grow with close to inflation, let's say 2%, and then 11 on the P price to free cash flow to say after 7 years, maybe their growth potential is nearly nothing, and so they don't deserve any premium. The return on invested capital is nothing too special, so no premiums shown really there. Let's see. Okay, 8% for free cash flow margin, 10% there. The debt, what would a 2% interest rate do to them? So about $4 billion, 2% of that, maybe 80 million. How much is 80 million? I mean, it's a pretty big dent on their free cash flow, or their earnings and free cash flow. So on a $200 million 5-year average, 80 million extra going towards interest expenses. It's going to be a pretty big dent on your margins. So I'm going to be fairly conservative on the margins here, maybe 6, 5, no share changes. Yeah, it's not looking super pretty as of now. We're saying that the company's stock price would have to fall 67% to get us to a 15% return given these assumptions. I think I'm fine with the assumptions. The business itself, again, the whole reason we're doing this screener is to get dividends with as much yield as possible that are very safe and comfortable. And I think right now their payout is exceeding their free cash flow, and we don't want them to keep going into debt to have to fund that dividend. We want them to rather cut the dividend, pay down some of that debt that they have that's not going to be excruciating. And the more they pay down that debt, hopefully their margins will help out through the interest expense minimizing. But for now, I'm definitely just going to be waiting on this company to do further research. Thank you, and I hope you have a great rest of your day.